Hello everyone, you are watching Saheb Academy. If you like our videos, then please subscribe to our channel and also hit the bell icon for the regular updates, and also follow us on Instagram, Saheb Academy. Now let's go to the video.
Hi everyone, welcome back to Saheb Academy. Now in today's fourth video of buyback chapter, we're going to solve this illustration 3 of the ICAI study material. But of our series, this is problem 2. Okay. Now I have chosen this question because here they are also asking to prepare the balance sheet after the buyback. Yeah. So you have to understand how to prepare the post balance sheet. Okay. So that's what we're going to focus on in this video. So now let's start this video. Let's understand what do we have in this question and then we're going to solve it. Okay, let's start. Now see the question over here. D Limited, a non-listed company, furnishes the following balance sheet as at 31st March 2021. So here we have been given the balance sheet and the amounts in this balance sheet are represented in thousand, but actually these amounts are in lakhs. These figures are in lakhs. See here, 2700 means what? It means 27 lakh. After this figure, there are 3 more zeros over there, yeah, which are invisible, yeah, which have not been written over here. Why? Because at the top in the column they have said in thousand. Yes, they are represented in thousand, but actually they are what? They are in lakhs. Okay, so 2700 means what? 2700 means 27 lakh. 1400 means 14 lakhs. 100 means 1 lakh, like that. Okay, 3 more zeros you have to add. Fine. Okay, so see the balance sheet over here. Simple balance sheet have been given. See, share capital, reserves and surplus. Note number we have. Share capital, note number 1. See here, 2,50,000 equity shares of rupees 10 each, fully paid up. 25 lakh. Yes, 2,50,000 into 10, that is 25 lakh. And then see here, 2,000 10% preference shares of rupees 100 each. So 2,000 into 100, that's 2 lakh. 200 means 2 lakh, like that. Yeah. Then in the bracket they have said issued 2 months back for the purpose of buyback. See here, this is a new thing. Here what is happening, the company has already done issue of preference shares for the buyback. So when we will replace the capital, we have to take this into consideration, and then the remaining balance we have to take out of CRR. We have to create CRR, like that. Okay, we'll see that while solving the problem. Fine. Right, then we have reserves and surplus. See here, 9,700. So note number, capital reserve, we will not touch that at all. Yeah, we'll keep it as it is. And then revenue reserve, free reserve, we can touch that. Securities premium, free reserve, only for this section 68 it's free reserve, so we can touch that. Profit and loss also free reserve. Fine, so that's what we have. And then see here, trade payables, that will be as it is. And then PP as it is, non-current investment as it is. Wait, what they are saying, they're saying something about investment, so this will change. Okay, next what do we have? Current assets, inventories 500, trade receivables 200, cash and cash equivalents 800. Now 500 means 5 lakh, 200 means 2 lakh, 800 means 8 lakh, like that. Okay, right. So then what they are saying, see here, the company passed a resolution to buy back 20% of its equity capital at rupees 50 per share. So the company has already passed a resolution, we don't have to test anything. Okay, right? So the company has already passed a resolution, so directly we can go for buyback, and it is 20% of its equity capital. 20% of equity capital means what? What's the equity capital over here? See, 2,50,000 equity shares. So 2,50,000 equity shares into 0.20, 20%, right? So how many number of shares are being bought back? 50,000 number of shares. Is that clear? Right. Then they are saying they are being bought back at rupees 50 per share. So this is the buyback price. This is the buyback price. The face value of the equity share is rupees 10 and it is bought back at rupees 50. So the remaining 40 rupees will be paid, yeah, which will be paid to equity shareholders. That would be premium on buyback. Fine. That would be a loss to the company. Yes. For this purpose, it sold all of its investment for rupees 22 lakh. The investment is being sold, all the investment. See here, we have how much? 30 lakh investment we have. Non-current investment 30 lakh. 3,000 means 30 lakh, right? So 30 lakh investments are being sold at how much? At 22 lakh. So of course we are incurring a loss of 8 lakhs. Is that clear? Right. So the simple question actually is just that here they're also asking for balance sheet, so you have to understand that properly. See here, past journal entries and prepare the balance sheet. So now let's go to the solution. Now here we have the solution. I have already prepared everything to save the time, and you all know my approach. First what I do is I make use of this equation to do the rough calculation of this problem. Yeah, the entire problem I solve it in rough over here, and then on the basis of this calculation I pass the journal entries and then prepare the balance sheet. It becomes very simple if we do it this way. Okay, so let's start. See here, it's very simple. The first thing that we need is number of shares to be bought back, and easily we can calculate that, because in the question they have said the company has passed a resolution to buy back 20% of its equity capital. So what's the total number of equity shares that are there in the company? 2,50,000 equity shares. So of that, take 20%, that is equal to 50,000 shares. Fine. So 50,000 shares are to be bought back at what price? What is the buyback price? Buyback price is rupees 50. See here, at 50, and then the face value of the equity share is rupees 10. Fine. So now what you have to do, let's jump into the equation. Yeah, see, the equation is very simple. Equity share capital plus premium is equal to equity share holders. Yeah, this is just the capital, just the face value, plus whatever extra that will be paid over the face value. Yeah, both these things will be paid to equity shareholders. Fine. So now let's calculate all these things. See here, how will you calculate equity share capital? You just have to calculate the face value. It's very simple. Number of shares to be bought back is 50,000 shares, and the face value is rupees 10. Just multiply that, you will get 5 lakh, isn't it? 50,000 into rupees 10, that is equal to 5 lakh. It is represented in thousands, so 500, isn't it? See here, let me just show you. This 50,000, you have to take it in calculator as 50. Yeah, because ignore the last 3 zeros. Yeah, so 50 into rupee 10, that is equal to how much? That is equal to 5 lakh. 500 means 5 lakh. Next we have premium, which will be paid over the face value, that is rupees 40. How did I get this rupees 40? See, it's very simple. 50 rupees buyback price minus the face value. The extra thing is rupees 40. So 50 into 40, that is equal to 20 lakh. 2000 means 20 lakh, right? So in total it is 25 lakh which will be paid to equity shareholders. Is that clear? Right. Now we have to go to the section 68. That's called replacement of capital. See here, this is very important part. 5 lakh capital is being bought back. It is being cancelled by the company. So this 5 lakh has to be replaced either through fresh issue, you all know, either through fresh issue or through creation of CRR by way of free reserves. All right. So the company has said, I mean the balance sheet it is given, the question has said that they have already issued preference shares. Yeah, 2 lakh of preference shares, isn't it? See here, 2000 into rupees 100, that is 2 lakh. So 2 lakh of preference shares have been already issued by the company for buyback, especially for buyback. So that's why you have to consider that here in replacement of capital. Preference shares 2 lakh. Okay. But you will not pass any journal entry of this. Why? Because it is already existing in the balance sheet. It has happened 2 months back, right? So you are not gonna pass any additional journal entry regarding that. It is already there in the balance sheet, therefore do not pass any additional journal entry. Is that clear? So if 2 lakh has been replaced already by preference shares, yeah, by issue of preference shares, then the remaining balance has to be CRR. Yeah, you have to create CRR through free reserves. You all know that. So you can use, you know, any free reserve which you have. Now here in section 68, securities premium is also free reserve. So whichever free reserve you want to use, you can use. Okay, you can use revenue reserve, you can use profit and loss account, you can use securities premium, whichever you want you can use. So the first we have over here is, first we have capital reserve, that is not a free reserve, we can't touch that. Revenue reserve will touch. So revenue reserve we have how much? 30 lakhs. So how much do we need? We need 3 lakh only, isn't it? 5 lakh needs to be replaced. If 2 lakh is replaced by preference shares, and the remaining has to come out of CRR. Yeah, we have to create CRR. So remaining balancing figure we have to create CRR, that is 3 lakh, isn't it? If 2 lakh has been replaced of 5 lakh, the remaining 3 lakh will be replaced by CRR. So what will happen? CRR will be created. This has to be credited. If you want to record the reserves, what you have to do? You have to credit the reserve. So this will increase, it will be credited, and revenue reserve, because we are utilizing this, so the money in revenue reserve will decrease. So you will have to debit this reserve, because reserves have which balance? Reserve is an equity, so it has credit balance. Yeah, if it is decreasing, then you will have to debit it. Keep that in mind. All right. So 3 lakh, fine, simple. Then what will happen? This premium is there. Now this premium is a loss to the company. Why is it a loss to the company? Because it is something that is being paid extra over the face value. Yeah, so that extra thing which company is paying, that's a loss to the company. So that loss, 20 lakh, has to be written off, and you can write that off by way of free reserves. Now free reserves you have, again, see here, you have revenue reserve, securities premium. Yeah, so what we're gonna do is we're gonna utilize securities premium. All right, we're gonna utilize securities premium. So let's do that. See here, securities premium, how much do we need? We need 20 lakh. We have 20 lakh, isn't it? See here, we have how much? We have more than that. We have 22 lakh in securities premium. So we're going to utilize securities premium by how much? 20 lakh. Fine. So securities premium will decrease by 20 lakh. So you will have to debit that. Reserves are decreasing, you will have to debit that. Simple logic. Fine. Is that clear? So we have done replacement of capital, return of the loss, premium on buyback. Clear? Right. Then the question says that the investments have been sold. Investment have been sold for 22 lakh. Yeah, now why the investments are being sold? Think logically. It's very simple. Now here section 68 is working, right? Here replacement of capital and here writing off of this loss is happening. Yes, but then what will be paid to equity shareholders? Cash. So company has to have cash, isn't it? They have to have cash. So if they don't have cash, they cannot pay to equity shareholders. See here in the balance sheet, if you can see, we have cash of how much? Only 8 lakh. So it's not enough to pay off the equity shareholders 25 lakh. We have only 8 lakh. So that's why the question says we have to, the investments have been sold off for 22 lakh so that the funds can be arranged. So I have always told you, in buyback of shares also, in redemption of preference shares also, there are two things. One is replacement of capital complying with the law, and the another thing is arrangement of funds. Now here they are talking about arrangement of funds. It's 22 lakh. Fine. So that's simple logic. So see here, to arrange the cash, all the investments have been sold for 22 lakh. So the book value of the investment was how much? It was 30 lakh. So 30 lakh minus it was sold for 22 lakh. Yeah, 2200. That's 22 lakh. Yes. So if you subtract that, then that's equal to 8 lakh. So 8 lakh is the loss the company has incurred, right? So this will be taken to profit and loss. Is that clear? Right. So that's it. This is just a rough calculation. Now let's do the journal entries. Let's pass the journal entries. It will be very simple to pass the journal entries because you have already got the idea what we're going to be doing over here. Yes, let's pass the journal entries. Now here we have the journal entries. Let's understand one by one how to pass these. It's very simple. See here, the first entry we have is the due entry. As a company, we have to accept that we have to pay 25 lakh to equity shareholders, and we have to cancel the capital because we are doing buyback of shares, and we have to record this loss. That's what we have to do in the first entry. It's based on the equation itself. See here, equity share capital account debit. We are debiting the capital account because we have to cancel it off. Capital has credit balance. To cancel it off, you'll have to debit 5 lakh. And then premium on buyback, this is a loss to the company, the extra thing the company is paying to equity shareholders. So this loss is an invisible expense. It's increasing, loss is increasing, so you have to record that. To record that, you have to debit it. You all know losses are always debited. Premium on buyback account debit 20 lakh. Yes. Next, what you have to do is you have to accept as a company we have to pay 25 lakh to equity shareholders. Yeah, it's a liability. Liability is increasing. We have to pay, right? So you have to credit equity shareholders account. But ICAI study material, what does it do is it takes this account, equity share buyback account, and this is what you have to take. Okay, we always have to follow the study material. Okay, to equity share buyback account. You can also take equity shareholders, but there is a chance that you might lose marks. So that's why, to be on the safe side, you have to take to equity share buyback account 25 lakh. Is that clear? Being money due to equity shareholders. Fine. Next entry we have is writing off of the premium on buyback. This premium on buyback is a loss which we recorded in the due entry. Now this loss has to be written off by utilizing the free reserve, and we've already done the calculation. We have utilized the securities premium by 20 lakh. 2000 means 20 lakh, right? So securities premium is decreasing. Yes, it's decreasing, so that's why you will have to debit that. Securities premium is a reserve, it's equity. To if it is reducing, you will have to debit that 20 lakh. And then premium on buyback, here in the due entry you recorded that, you debited that. Now here you are going to cancel it off, you're writing it off, so you'll credit that to premium on buyback account 20 lakh. Is that clear? So being premium on buyback written off. Next, what you're going to do is, next you have replacement of capital. Now in replacement of capital, fresh issue is done 2 months back. It's not actually a fresh issue, right? It's done 2 months back and it's already there in the balance sheet, so you must not pass any additional journal entry. Okay, this 2 lakh preference shares, it is already existing in the balance sheet which is given in the question, so that's why we are not gonna pass any additional journal entry. See here in the balance sheet in the question, it's already there. Okay, so no additional journal entry for that. You will only pass the journal entry for CRR, creation of CRR. Now what is happening over here? Here we have created 3 lakh of CRR by way of revenue reserve. So revenue reserve is decreasing, you will have to debit this, and CRR is increasing, you will have to credit that. So the entry would be very simple: revenue reserve account debit, it's decreasing, reserve is decreasing, you will debit that 3 lakh, and to capital redemption reserve. Yes, CRR is increasing, you will have to credit that, being CRR created out of revenue reserve. Simple as that. Clear? Right. Next, what you have to do? Next, you have to pay off equity shareholders 25 lakh, because you have complied with the section 68, you have written off the, what do you say, premium on buyback. Yeah, you have done everything, but then we don't have enough cash to pay off to equity shareholders. Yeah, we don't have enough cash. We have only what? We have only 8 lakh cash and cash equivalents, 8 lakh. So what do we have to do? The question says we have to sell off the investments for all the investments for 22 lakh. So that's what we have to do. We have to pass general entry for that. Yep, I've already told you. So see here, the entry is very simple. You have sold off the investment for 22 lakh. So you will receive how much? You will receive 22 lakh. Bank account debit 22 lakh. And then investment book value was 30 lakhs. So you will credit the investment account by 30 lakh, because all of the investments are sold, right? Everything is sold. If everything is sold, then that entire investment, all the investment will have to be credited, because it's no more. Yeah, from the balance sheet, it has to completely be taken out. So that's why you will have to credit the entire 30 lakhs. Then the balancing figure would be profit and loss account on the debit. Why? Because it's a loss. Yeah, book value is 30 lakh. We have sold it off for 22 lakh. So the loss is 8 lakh. So losses are always debited. So we will debit profit and loss account 8 lakh. Clear? Being investment sold at a loss for purpose of buyback. Clear? Next, what you're going to do? Simple. You're going to pay off the equity shareholders. Yeah, 25 lakh. So the entry for that is very simple. In the due entry, you accepted as a company, we have to pay. You created a liability over here of 25 lakh. That liability which you created needs to be cancelled out over here. Yeah, here liability was increasing, you credited that. Here liability is decreasing because you're paying the equity shareholders off. So their account, you will have to debit that. Liability is decreasing, you will have to debit their account. Equity share buyback account debit 25 lakh, and money is decreasing in bank account to bank account 25 lakh, being the payment made to equity shareholders on buyback. Simple as that. Do you get this? Easy, right? So this is how you will pass the general entries. All the things you will have to base on this calculation, this equation calculation. And then there might be some extra entries such as this investment. Yeah, some extra entries might be there. You will have to see the question properly. Fine. But the core, the buyback part will be based on this only. Fine. Right. So now let's see how to prepare the balance sheet after this buyback. Now let's understand how to prepare the balance sheet after buyback of shares. See, it's very simple. All you have to do is look into the question for the old balance sheet. Yeah, the same thing you have to do with little bit changes. So think where changes can come. You have done buyback of shares. So because of buyback of shares, what happens? Share capital decreases and reserves and surplus gets completely messed up. Yeah, so that's why first let's focus on these two things. In share capital, what happened? Share capital decreased. Yeah, number of shares also and the amount of capital also decreased. So what was that decrease? Let's see that. See here, we had 250,000 equity shares. We bought back 50,000 equity shares. So in the new balance sheet, how much shares should be there? Only 2 lakh equity shares. Is that clear? 2 lakh equity shares of rupees 10, that's equal to 20 lakh. Yeah, we had 25 lakh amount. So 5 lakh is gone. So in the new balance sheet, only 20 lakh will be there. And then we haven't touched the preference shares at all. Yeah, it was issued 2 months back to replace the capital. Yes, so we haven't touched anything of preference shares. Yeah, so it will be as it is in the new balance sheet also. Fine. So let's see that. See here, share capital, note number 1. See here, 22 lakh. How 22 lakh? Let's understand that. See, share capital, of course, authorized, issued and subscribed capital you will write. And then there's a mistake over here. See, they have taken over here 250,000 equity shares, which is incorrect. In the new balance sheet, this is the new balance sheet. Yeah, in the new balance sheet, only 2 lakh equity shares are there because 50,000 has been bought back. So 2 lakh equity shares into rupees 10, that's equal to 20 lakh. 2000 means 20 lakh. So 20 lakh. And then preference shares as it is, we haven't touched that. So 2 lakh. So 20 lakh plus 2 lakh, that's equal to 22 lakh. Is that clear? Share capital 22 lakh. Next big change has been in the reserves and surplus. See here, reserves and surplus previously we had, see, reserves and surplus previously we had 97 lakh. 9,700 means 97 lakh. Capital reserve, which we haven't touched at all. yeah, because there was not a free reserve. We haven't touched capital reserve. And then revenue reserve, we have decreased that. Yeah, see here, let's just see that calculation. We have created a new reserve called as capital redemption reserve, CRR, of 3 lakh by decreasing revenue reserve of 3 lakh. Yeah, so you have to take this into consideration. And then here we have utilized, we have decreased the securities premium by 20 lakh to write off the premium on buyback. So all these things you have to consider. It's very simple. Revenue reserve has been decreased by 3 lakh. Yeah, so let's go see here, reserves and surplus. How much? 69 lakh. How? Let's see that. Reserves and surplus, capital reserve as it is, 10 lakh as it is. Yeah, you haven't done anything to that. And then capital redemption reserve, it has come into existence. We created that of 3 lakh from the revenue reserve. Yeah, right. Then securities premium, previously we had how much? 22 lakh. See here, securities premium 22 lakh we had in the question. Yeah, 22 lakh minus we have written off the premium payable on buyback, that was 20 lakh. So 22 lakh minus 20 lakh, that's equal to 2 lakh. 2 lakh is the balance of securities premium. Then revenue reserve also we utilized to transfer to capital redemption reserve. So revenue reserve previously in the balance sheet was how much? 30 lakhs. So 30 lakh minus 3 lakh, that is equal to 27 lakh. Then we have profit and loss. In the old balance sheet, profit and loss was 35 lakh. 3,500 means 35 lakh. So profit and loss we have utilized, haven't we? Yes. See, when we sold off the investment for 22 lakh, we sold it at a loss of 8 lakh because the book value was 3 lakh, right? 30 lakh, sorry, 30 lakh, right? So that loss 8 lakh is to be taken to profit and loss. It has to be adjusted in profit and loss. You have seen the journal entry also. We have debited the profit and loss. So if profit and loss is getting debited, means profit and loss is decreasing. You're utilizing that to write off that loss. So that's why, you know, 35 lakh minus 8 lakh, that is equal to 27 lakh. Is that clear? So if you add up all of this, that would be equal to 69 lakh. Is that clear? So that's reserves and surplus. Fine. And then we have current liabilities, trade payables. We haven't touched that at all. It is as it is. Trade payables, see here, 14 lakh, 14 lakh. Yes. So the total is, we'll come to the total later. Then in the asset side, see, we had property, plant and equipment of how much? Of 93 lakh. We haven't touched that too. Yeah, it is as it is, 93 lakh. And then non-current investment is completely gone because we have completely sold it off. So it will disappear from the new balance sheet. It will not be there. See here, it's not there. Yeah. And then current assets, in current asset we haven't touched inventory and trade receivables as it is, 5 lakh and 2 lakh, 5 lakh and 2 lakh. But cash and cash equivalent, there is a change, isn't it? Cash and cash equivalents in the old balance sheet we had 8 lakh, right? We had 8 lakh. And then what happened was, see here, we had 8 lakh in the old balance sheet. See here, 8 lakh. And then we got 22 lakh from selling of the investments. Yeah, see here, 8 lakh we already had in the old balance sheet. Then we sold off the investment for 22 lakh. So we got 22 lakh. So the total cash was how much? 30 lakh. Minus how much did we pay to equity shareholders? We paid 25 lakh to equity shareholders, didn't we? Of course we did. 25 lakh. Yeah, we did pay 25 lakh to equity shareholders. So you will minus 25 lakh minus 25, that's equal to 5 lakh. Yes, so 5 lakh is the remaining balance in cash and cash equivalent. That much cash we have. Fine. So that's it. So this is how you will have to prepare the balance sheet. It's that simple. Yeah, the main thing is share capital and reserves and surplus only. And then it depends, if some investments have been sold off or some special entries there, then you have to take that into consideration properly. And then yeah, that's it. That's how you prepare the balance sheet. Okay, see you in the next video. I hope you got this. Yeah, it's all about that calculation. If you do this calculation properly, yeah, and you can do it very fast, yeah, once you practice many sums, then you will feel this is very simple. Okay, right. Now from the next video, what we're going to do is we're going to see that test. Okay, right, debt equity ratio and all that test. Fine, that's it for this video. Now see you in the next video. Yeah, bye.